From the morning reading, technology ETFs test November highs. Although big tech's lead rally, equal weight ETF shows strength. Semiconductor ETF at 6-month high. Intel and Nvidia are chip leaders. Strong dollar may help airlines by making international travel cheaper. S&P 500 equal weight ETF struggles to stay above the 200-day average. Technology stocks continue to lead the market higher. It's usually a good sign when the economically sensitive technology sector is leading the market higher, and it is. The technology sector spider XLK is in the process of testing its November high. Its relative strength is already a new high ground. Technology strength is helping to drive the NASDAQ market higher, and in particular, large stocks. That's good for the NASDAQ 100, which is comprised of the largest 100 non-financial stocks in the NASDAQ universe. NASDAQ Unweighted Index plays catch-up. The NASDAQ 100 Trust QQQ is a market-weighted ETF that gives greater weight to larger stocks like Apple, 12%, Microsoft, 8%, Amazon, 6%, Google, 5%, Facebook, 4%, and Intel, 3%. Of those 6 stocks, 4 of them have recently hit new highs. Compare the performance of the First Trust NASDAQ 100 equal weight ETF to the cap-weighted QQQ. It's clear that the market cap version is stronger. The good news, however, is that the equal weight version isn't that far behind. And that's important because we've been talking about market breadth quite a bit of late, and at least with respect to the NASDAQ, it would seem that we're starting to see some catch up between the equal weight and the market weight. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:44 a.m. Central Time, and I'm recording this in preparation for the market day of December the 3rd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. In addition to this morning market preview video that I post to the YouTube, and I know many of you are also subscribers to the YouTube channel, that way you get alerted as soon as this is posted each morning. I did want to bring your attention to the Twitter. If you follow me on Twitter, which is at Falcon Global LLC, I also comb through some of the very best financial postings each day and then forward those on to your reading. They're strictly about business or the financial markets in some way. I stay pretty close to that theme, so it's all business all the time, as it were. But you might find that some of the stuff that I'm forwarding is of great interest to you, and you might find that my compiling some of those best ofs and sending those out would be of interest to you. So you might also want to follow me on the Twitter feed. So let's go ahead and dive into the morning report. And overnight action was pretty strong, and especially when you consider that the end of the day yesterday had a classic traders, day traders pivot inflection point, where 3 of the 4 indices came down to about the S2 area and then inflected. So we were up off the lows of the day yesterday, and then in the overnight we continued to be more bullish. So we're quite a bit up off that inflection point from the intraday low from yesterday. On the S&P futures are up almost 11 points, or about 0.5%. Russell futures also 0.5%. NASDAQ futures even more strength there at over 0.6%, and then the Dow futures also about 0.5%. Crude oil up about 1.5%. Euro down about 2/3%. The I should mention though, right now the dollar is really been moving around. And of course, we have some important macroeconomic reports today. So that situation with the euro and the dollar and all could change between now and the cash open. In terms of bonds, they're down about 0.2%, and then gold is down about 0.4%. And overseas action, mostly bullish. China up about 1.4%, Hong Kong down about 0.3%, Japan right at scratch. Germany up about 1%, and the United Kingdom up about 0.33%. In terms of today's macroeconomic reports, we had the weekly variety of the unemployment claims, and that combined with the ADP report that was released yesterday should give us some leading edge into the monthly employment report, which is going to be the big one that will be released tomorrow morning. You also have Fed Chair Yellen speaking in front of Congress, I guess. It says testifies. And the other thing to say about that is she was talking yesterday, and the inflection point of the market yesterday, the point in which it started getting weak in a pronounced way, was apparently associated with when she started to talk about interest rates. So you'd like to think that it's all baked in and they've already discounted the market for the change in interest rates, which could have happened around the December 16th meeting. And yet at the same time, it seems like every time the market takes in a new comment, it seems to inflect. So, you know, which is it? Does the market cook this stuff in? And is the price, I should say the rate increase already baked into the market, or is it not? It would seem that at least that there's a good bit of volatility yet to be seen around that announcement. Overall, once that announcement is made, the expectation is that it will remove some of the ambiguity that has had much of the market sitting on the fence post. And indeed, let's see if there's anything else in the U.S. We got non-manufacturing PMI, and I think that's about it. In terms of tomorrow, I want to head to the charts here, but let's go ahead and finish this off while we're here. Let's see. Non-farm employment change, of course, the big one we talked about. Also important, trade balance. So you got a couple big reports that will be coming out before the cash open tomorrow morning. So you got to have that in your mind before the market closes today. Is there anything that you want to lock in profits on? Is there anything that you need to hedge? Because we could be at a very different place potentially when the cash market opens back up tomorrow. So let's go ahead and head to those charts. So you see the SPX, quite a bit of volatility here in the last 3 days. We had 7 days with, almost on an annual basis, the smallest intraday ranges that we have had in a year. But that's been now followed by 3 days of consecutive reversal volatility. So we had a fairly decent down day on Monday, total reversal on Tuesday, big up day, and then we'll call this, well, it doesn't technically meet the definition of dark cloud cover. We'll call this dark cloud cover. It also behaves much like a tweezer pattern with very similar close followed by a similar open with a full body reversal, and this in this case totally enveloping the prior body. So but, if you get down to it, it's pretty much the same place we started at with the close on Monday. So really haven't gone anywhere. And indeed, even if you take it back to where this small body action started, so that closed right here, we'll call it 2084, and yesterday closed at 2079, 4 points, not that big a deal. So a lot of chatter and even some volatility, all to remain pretty much in the same place where we started at the end of this significant swing move that took us into this range some 8 trading days or so ago. So that's kind of interesting. The other thing is I thought of interest is if you take a look at TLT and you go back some time, and all the way back here to 2014. You can draw a triangle from this swing low across here, and then draw another coming across here. You have a symmetrical triangle on this long-term time frame, and what have bonds been doing? They've been getting tighter and tighter and tighter. Well, chicken and egg, is it because the Fed, or is the impending Fed decision going to be what all this is fence sitting in effect has been about? Well, this pattern is getting tighter and tighter and tighter leading into this Fed announcement, and we're going to be right at the apex of this pattern as we go into the Fed announcement, and that is likely to be the stimulus that breaks this out of this symmetrical triangle and either breaks us up or breaks us down into what could be a significant move. So kind of keep all that in mind. There's some very interesting things happening. In addition, when you look at the long-term patterns of the indices, we've gone into this kind of range-bound action through much of the last few months. Remember, these are weekly candles. We spent months here in this tight pattern. Broke down in August just to come back pretty much right back into the same range. Well, as that pattern breaks out, what's going to be the stimulus? Well, the reason this pattern is formed and the stimulus to break out of this pattern could very well be the fence sitting that has occurred waiting for the Fed month after month in 2015 to finally get off and make a rate increase, versus having that information and starting that process and removing that ambiguity. So kind of think about that as we head into the middle of this month and we get into the release of that Fed decision, which is now over a 75% probability expectation based on bond futures as to what they're going to do, that they will proceed forward. Now, yesterday's action in the Russell, of course, Russell's been relatively weaker than the other three indices, but made a larger move in recent trading sessions to play catch up. That gave back some of that yesterday, but not surprising. This is an insignificant pullback in the context of this move right here. So far, this means nothing in terms of damaging the bullishness of the Russell on the short term. Now, in the intermediate term, it's also bullish, but in the long term, that's a much sloppier pattern. So we need to see, not just in the Russell, not just in the NASDAQ and the SPX, we need to see some resolution. Now, of course, the NASDAQ actually had an intraday high yesterday put in, though it closed well off of that. So it tickled by just a few cents, a new intraday high from these recent swing highs. Remember, the NASDAQ has been the strongest of relative note of late, but then it backed totally off of that and indeed had a dark cloud cover reversal pattern on the day. So not a great way to set a new 52-week high. And then last, the Dow, also that kind of similar pattern to the SPX. And let's take a quick look at the volatility futures. A little bit of an uptick in volatility yesterday. So far today, it's ebbing off. Remember, this is futures, so this is already today's candle being formed. We're down in the bull range volatility, below that 18, that 12 to 18 range we like to think of as kind of a bull market range for volatility. Nothing particularly scary or alarming there. And I think that's enough. We've already been into the bonds. Let's go to the market condition. We spoke about volatility a moment ago. Short-term VIX at 15.97. Nothing particularly exciting there. Skew continues to remain relatively elevated at about 5-6 times normal market conditions, and about a 10% probability of a 2 standard deviation move in the next 30 days. IV percentiles for the SPX a 19, for the Russell 14, for the NASDAQ a 14, and for the Dow a 19. These are all very, very low. Indeed, they're all below the 20th percentile, so nothing here that would get you terribly excited. Standard deviation moves were put in by 3 of the 4 indices yesterday. So while the NASDAQ did fall off on a close-to-close standard basis, it did not put in a standard deviation move, so that's kind of interesting there. So a couple days of a little bit more volatility going on after several quiet days with the Thanksgiving week mostly. But anyhow, bottom line is this is still relatively normal. 4 standard deviation move days within a 2-week period on the S&P is absolutely the average. So right now, while it seems like we're seeing these pockets of volatility, the overall IV percentiles, the short-term VIX, and other measures aren't telling us that there's anything in particular alarming or concerning here at this point. In terms of the regular daily report, we still remain at phase 2. We've had that diagonal breakout. We're looking to now start to see bull flag patterns, which would move us into phase 3. Haven't quite seen that established yet, and probably with the resolution in the next couple of weeks, we'll start to see that either the bull flag patterns will break into the norm, or we'll start to see a breakdown of this transition process. And indeed, we've been in a multi-week transition zone. IBD status remains confirmed uptrend, but the accumulation distribution score, still remains relatively weak at a C-. NASDAQ also at a C-. We talked about in the morning reading that there were some interesting headlines there where breadth has been improving to some degree with the NASDAQ, but it's still has room for improvement at the very least. GMI index of perfect 6 out of 6. That buy signal has been in place since 1019. That author remains, though, largely in cash and is being very, very selective in putting in new positions. Primary market condition as marked by the relationship of key moving average lines is in a neutral bear. That's also reflected in another system here, the stock chart's decision point status. And you see on the short term, mixed signals. On the long term, mixed signals. On the intermediate term, nicely stacked, all bullish. Until these 3 time frame stacks come in alignment, we are going to remain, much as you see here with this definition, in a mixed time frame condition, and that will leave us in something of a transition zone that needs to be resolved. That being said, the consensus of all this is more bullish than bearish. So I would say transition with an expectation to the bullish bias until new information comes in. In terms of that new information, the intermediate term market posture certainly is part of that. It's currently flipped back to bearish, but still has an upslope sentiment. So just as mixed as the other mechanical signals above. In terms of position sizing opinions, both systems are still at 100%. In terms of that intermediate term market posture, you see we now have 2 markets that have gone to bearish. We had earlier in the week, the S&P was very bullish, flipped to bearish, flipped back to very bullish, and now back to bearish. And you can see what happens when you have any kind of indicator really that is nearly flat. It's real easy to have signals flipping back and forth wrapped around that center point line. And that's very much what's happening here until we get some resolution from this intermediate term market posture and kind of set up anything that looks like a trend. Will likely get these kind of mixed signals going back and forth. And this is true, you'll notice with many of your indicators that you're fond of, anything that is based on moving averages especially, will often find itself wrapped and very choppy, having a lot of false signals anytime you have a sideways or range-bound market, and that certainly defines our overall chart patterns in the indices of late. In terms of hedge warning status, we remain level 0 plus, normal with some elevated risk conditions, and those elevated risk conditions have increased this week, so that's something to kind of keep in mind. We're still retaining this bullish bias, normal trading kind of condition, but at the same time, you've got a circumstance where you've got to recognize that more elevated risk conditions are coming into the market. We've had market in decline, sharp increase warning. We added to the distribution day count. NASDAQ's now at a 7. Skew remains elevated. And then also down here, very importantly, all 5 of the intermarket risk aversion indicators are currently risk off. In terms of special opinions, no changes here. I'll let you just hit pause button and read that if you need more time on that today. We've gone a little bit longer today, had a lot of things happening. But the bottom line to this is all these little references to how you can become a bit more defensive, you might want to keep that in mind right now. In terms of sector specific, you see we did have some damage yesterday. Note the sectors that are down across all 3 time frames and the sectors that are up on all 3 time frames. That'll give you some relative value as to which ones are holding up the best and which ones are the first to fall. Obviously, everything falls on a significant down day in the market, and that certainly was true on the percent change charts for yesterday. So, I mentioned about following us on social media. We greatly appreciate that. Please do acknowledge these efforts if you find them useful to your traders, to yourself, and to your trading, and retweet us to your Twitter followers and the like. Some special offerings, and I'll just flip through these. We'll talk more about them on a shorter day. Disclaimers as always, hit the pause button if you need more time to review. And we'll be back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.